Hello, this is your daily dose of financial market trends. China's economic slowdown is sending shockwaves through mega-cap tech stocks, while a looming 50% tariff threat against Canada could reshape North American trade. Let's break down what's moving markets this Monday. Heading into this morning's session, Friday's close had markets pointing slightly lower across the board. The S&P 500 finished at 7785, down about 0.2%. The Nasdaq closed Friday at 26,729, losing about 0.25%, while the Dow ended at 53,732, also down 0.2. The VIX ticked up nearly 5% to just under 15, and the 10-year Treasury yield climbed to 4.7%. Let's dive into what's catching attention today, starting with NVIDIA. The chipmaker is showing up across multiple corners of the market, and the China story is a big reason why. With Beijing's economy showing continued weakness and domestic investment declining, there's growing concern about demand from one of NVIDIA's most important regions. The company reports earnings next week on August 26th, so investors are watching closely to see how management addresses the China exposure question during that call. Alibaba is making waves for two distinct reasons. First, the company just announced it's dropping its gaming division as it pivots more aggressively toward artificial intelligence initiatives. That's a meaningful strategic shift for China's e-commerce giant. Second, the stock managed to gain over 1% on Friday, despite the broader China slowdown narrative weighing on sentiment. Alibaba reports earnings this Wednesday, August 20th, and guidance around consumer spending trends will be critical given the macro headwinds. TSMC is getting hit from multiple angles today. The world's largest chip manufacturer saw its stock drop nearly 1% Friday, and it's experiencing a sharp spike in social media discussion. The China economic concerns are front and center here too, since weakening demand from Chinese tech companies and smartphone makers could pressure TSMC's order book in the coming quarters. Any slowdown in global semiconductor demand tends to show up in Taiwan Semi's numbers first. Meta Platforms is seeing unusual attention this morning, with social media chatter up dramatically. The stock slipped about 0.9% Friday, and the focus seems to be on the company's massive AI infrastructure spending. As the broader investment wave in artificial intelligence continues, investors are debating whether Meta's capital expenditures will deliver returns or simply compress margins. The company's exposure to global advertising demand also makes it sensitive to any economic slowdown in major markets like China. Three major geopolitical situations are shaping market scenarios right now. First, the ongoing Iran conflict and its impact on energy markets. Current military operations involving Iran are disrupting global energy flows and raising supply concerns. The bull case, sitting at 35% probability, assumes successful peace negotiations lead to a ceasefire. If that happens, oil prices could drop 15 to 25% as risk premiums evaporate, benefiting transportation and manufacturing companies while pressuring energy stocks. The bear case, at 45%, envisions escalation that disrupts the Strait of Hormuz, pushing crude past $100 a barrel and forcing central banks to keep rates high despite growth concerns. Second, the US-Canada tariff confrontation is creating serious uncertainty. The administration is threatening 50% tariffs on Canadian imports, putting over $700 billion in annual trade at risk. The bull scenario, at 40%, assumes negotiations produce a compromise that avoids tariffs, triggering a 3 to 5% relief rally in North American equities. The bear case, at 55% probability, sees tariffs actually implemented with Canadian retaliation, causing immediate cost inflation of 8 to 15% for affected U.S. goods and reigniting the Fed's inflation fight. Third, China's economic slowdown continues deepening. Domestic investment is declining structurally while broader indicators weaken. The bull case, just 30%, requires Beijing to launch major fiscal stimulus exceeding 3% of GDP, which would stabilize commodity demand and lift multinational revenue expectations. The bear case at 60% assumes incremental policy responses that fail to reverse the trend, creating 10 to 20% revenue headwinds for companies with China exposure and exporting deflationary pressure globally. On the housing front, mortgage rates have climbed to 6.67% for a 30-year fixed loan, while inventory has swelled to 9.3 months of supply. That's well above the balanced market threshold of 6 months. Home price growth has slowed to just 1.1% annually, and building permits are declining, suggesting builders are getting cautious about future demand. For earnings this week, Alibaba reports Wednesday, August 20th. Given the China slowdown narrative dominating discussions, that report could set the tone for how investors think about Chinese consumer demand heading into fall. So what does this all mean for your portfolio? 5 things worth watching. First, China exposure is becoming a real liability for multinational tech and chip companies, with revenue headwinds potentially hitting 10 to 20% if weakness persists. Second, energy markets are caught between geopolitical risk premiums and demand destruction concerns, creating unusual volatility that could swing oil prices violently in either direction. Third, the tariff threat against Canada isn't priced in yet, and if implemented, it would reverse the goods deflation that's been helping the Fed's inflation fight. Fourth, housing market dynamics are shifting toward oversupply, with 9 months of inventory suggesting home prices could face downward pressure if rates stay elevated. And fifth, earnings season commentary on China and AI infrastructure spending will matter more than usual this cycle, given the macro uncertainty around both themes. As always, this is educational content, not financial advice. Do your own research and consider your personal situation before making any investment decision. That's your Morning Market Digest for Monday, August 17th. We'll be back tomorrow morning with whatever markets throw at us next. Trade smart out there.